Look, the issue here is that the main driver really isn't the Bank of England. It's fiscal policy. It's the instability that it has created in the market. You look at the pension sector, you look at the mortgage market as well, and the bank, understandably, is trying to fulfill its mandate for financial stability. These headlines are market moving, of course. We've seen what they've done to the gilt market, what they've done to the currency. Sterling was first falling sharply, but after those headlines suggested that, after all, the purchases could continue a while longer. Sterling has recovered. So absolutely, I suspect it's going to be a few weeks of volatility and uncertainty in the marketplace. The next catalyst, basically, what could stabilize the situation or not, is the full budget with the OBR forecast alongside it.
I can assure you the crisis is over, Daniele. I've just seen a flash from the UK Business Minister. Thank goodness for that. This is Jacob Rees-Mogg, who our viewers may be aware of. There doesn't seem to be a systemic problem in pension funds. This is according to Jacob Rees-Mogg. There doesn't seem to be a systemic problem in pension funds. We can all relax now, can't we, Daniele?
Look, I think the way I would suggest one needs to approach this is very simple. So there is a degree of work that the bank has to do because borrowing requirements now are projected to be much higher because of the margin calls that we have seen and we know of in the pension system. That's the main issue. Of course, headlines cannot stabilize this. The market needs action. There has been some action, but the situation remains very, very fluid.
Can I ask you, Daniele, where we go then on interest rates? Because one of the reasons cited for pulling back on some of the support here was that it will clash with the bank's monetary ambition to raise interest rates. Where exactly are we now going on interest rates, given there's still variables around what the Chancellor will do from here?
Okay, sure. First, maybe I will make a distinction. I know it's a subtle distinction, but this is not monetary policy QE. It's not that. All right? So these are temporary, it seems, purchases to stabilize the financial system. It's very, very different. So generally speaking, I think we'll continue to see a hawkish Bank of England. Despite their intervention and the Truss government's partial U-turn on fiscal policy that seemed to have calmed markets to some degree initially, but not fully, as we have seen recently and overnight. So what I think that we'll have is extra interest rate hikes. They may well raise rates by north of 100 basis points, I think, to 3.25%, 3.5% at the November meeting. I would expect in the near term, possibly equally large or anyway, significant hikes. Market pricing is even higher than that, actually. So there is a risk, actually, that the bank under-delivers somewhat to those expectations. But the basic point here I'm trying to make is that we are looking for an increase in rates. All central banks, maybe the BOJ aside, are really focused on that. They need to tighten financial conditions to tame inflation. They don't want to do this in a disorderly fashion, and here is the challenge for the UK. But certainly, I think they are really focused on bringing inflation closer to target.
If I can ask you the what breaks question, I mean, the markets are concerned that central banks move too aggressively, eventually break something. If you look at the data today that we've had crossing around the economy, and 2% growth year over year, we're falling on a monthly basis. If you look at the industrial manufacturing side, we are negative there. Services, the only remaining bright hope, really, along with construction at this stage. Does the central bank break those two particular parts of the economy too?
I would think that central banks are focused on the inflation part of their mandate. In most cases, they are only formal mandate alongside ensuring a smooth functioning of the financial system. So if by breaking you mean slowing the economy, potentially also triggering a recession, my answer would be yes. They'd rather do that than leave very high inflation levels ingrained in people's and firms' psychology, which would require many more rate hikes in the future. That said, it doesn't mean that they will continue to raise rates that aggressively or that they will keep raising them once we are in recession. At some point, the trade-off will change. But for that, we need to see weaker demand, a slowdown in the economy, and in the case of the UK or the Eurozone, for that matter, probably a recession, which is my base case.